I am very bullish precious metals as we speak. I mean, I think this little pullback, the sharp pullback we had is over, and I think silver can go to 100 here pre-bust. Post-bust, I'm calling for 20,000 gold and 500 silver, probably in the early 2030s.
I think the secular bull will end up out, I think, around $6,000.
Where we are today, we've got gold miners have had the big move. Silver, we've seen platinum, we've seen palladium. They've all just recently had the little bit of a pause or pullback, and they're starting to push higher. And of course, that's real. We're getting kind of right into this phase where we could start to see a very big move up in the precious metal space.
Market strategists David Hunter, Steve Hanke, and Chris Vermeulen outline why the current setup in precious metals may be far more explosive than most investors expect. They note that the recent sharp pullback has likely run its course, clearing out weak hands and setting the stage for the next significant advance. Silver, after stabilizing at higher lows, now has the potential to surge toward the $100 level before the broader economic breakdown unfolds. In the longer term, their outlook projects a far more dramatic revaluation, with gold potentially reaching $20,000 and silver near $500 in the early 20s to 30s as the cycle comes to a close. Even before that secular peak, a move towards $6,000 gold remains firmly on the table. With miners, platinum, and palladium already turning higher after brief pauses, the precious metals space is entering a powerful new phase. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
But when you go and you look at precious metals, gold is through the roof. We could, there's a really interesting comparison chart. If we share my screen here, I can show you there's two charts that I can share. The left chart is the candlestick chart, is the S&P 500 back in 2007, just as the stock market put in a major top. The yellow line is the price of gold. Now, both of these were rallying together. And when you see gold dramatically moving higher with the stock market, it's a big red flag. Something's wrong. People aren't trusting the financial system. They don't trust the governments. They don't trust currencies. They're worried about all kinds of things. So when gold starts to just take the lead and run higher, we need to be aware that there's something unfolding that we're not going to like. And it's going to be hard on the economy, probably the stock market. Now, if we take a look at the chart on the right-hand side, we have the same. We've had gold rally for this, last year and a half. We've had the stock market rally hitting all-time highs. The really interesting comparison when we look at these two, now the market environment is different, like the economic environment, and it always is for every major market top. But this is what I want to share and kind of show where we're at. So I've just added a whole bunch of charts down below. We've got gold miners, we have silver, we have platinum, and we have palladium. And what happens here is we've just, back over here, we started to see a bunch of money pile into gold miners. We saw a bunch of money pile into silver, into platinum, into palladium. And then they all went and had a little bit of a pullback. Now, these are all weekly charts. And this is as the stock market was just putting in a major market top. Gold was pushing to testing all-time highs. And what's interesting is if we were to drag forward, let's just look at the stock market and gold here. Stock market fell about 20%, and gold continued to rally. Gold had this very, very big move. I'll just backtrack a bit here. Stock market put in the top, precious metals went higher. And if you take a look, you'll notice gold miners down below rallied. Silver rallied like over 50%. Platinum and palladium both rallied over 50%. And then once the stock market momentum really stalled out, and the tide actually changed, we saw the stock market collapse, and it fell over 50%, and it pulled the commodity space down, which generally in a recession, almost everything goes down. And so the same thing happened. All the other commodities sold off 50, 60, 70, 80% during that reset. So if we just backtrack here, Anthony, and look at kind of gold hitting highs, the stock market showing a little bit of weakness, and we look at to where we are today, where we are today. We've got gold miners have had the big move. Silver, we've seen platinum, we've seen palladium. They've all just recently had the little bit of a pause or pullback, and they're starting to push higher. And of course, we're getting kind of right into this phase where we could start to see a very big move up in the precious metal space. And this is usually going to be the signal that the stock market is on the cusp of a major market top and selling off. So this is my biggest barometer. When you see the whole world moving away from the financial system and buying physical gold and silver, that is a sign that big money is trying to protect themselves because they see or sense something bad unfolding in the economy. And like the whole world, really, gold is the global barometer. So this isn't just like United States or Canada based. This is gold tells us like something is wrong across the board and people are trying to protect their capital.
I am very bullish precious metals as we speak. I mean, I think this little pullback, the sharp pullback we had is over, and I think silver can go to 100 here pre-bust, gold can go to 5,000 pre-bust, and I think I'm probably conservative there. During the bust, I think almost all assets other than treasuries get hit. So, as I say,
your winners.
You have to be careful that you're not standing on the south rim of the Grand Canyon looking across the north rim and thinking you can just hold these things right through, because there's a canyon in between. But post-bust, I'm calling for 20,000 gold and 500 silver, probably in the early 2030s. If inflation does what I expect, precious metals are going to be the top game in town. By the way, I'm also calling for $500.
I think the secular bull will end up out, I think, around $6,000.
Fantastic.
Right now we've had a little pullback. We're stuck around 4,000 solidate, which seems to be, they're sticking to it like flies stick to fly paper. But it's going up because the ratio of calls put 4,000 contracts ending November 24th. It's about 2-1. The calls outnumber the puts, so that means the market thinks price up. It might be consolidating at 4, but they think it's going to go higher, not lower.
Chris Vermeulen highlights a powerful warning signal developing beneath the surface of the markets. When gold surges while equities are still pushing toward highs, just as we saw before the 2007 top, it reflects a breakdown in trust across the global financial system. Capital begins flowing into gold miners, silver, platinum, and palladium as investors quietly hedge against structural risk. David Hunter and Steve Hanke note the same pattern today. Metals rallied, paused briefly, and are now turning higher again, often a precursor to a significant shift in market momentum. Historically, this rotation has signaled that stocks are nearing a top, while precious metals enter an acceleration phase. With miners strengthening and gold serving as the global barometer of stress, the setup for a significant move in the metals is rapidly building. Let's get into the interview.
Well, for example, the miners in bull markets usually outperform the metals, and I think that will hold true in the post-bust period. So if silver goes from, let's say it goes to 100 pre-bust, goes down to maybe 40 or 30 in the bust, and then goes to 500, so it's a 15-fold increase, let's say. Miners probably have a bigger increase than that, at least the good miners. So there'll be plenty of opportunities in stocks. But the indexes, the broad indexes like the S&P and the NASDAQ and the Russell, et cetera, keep in mind how the math works. At the top, they're heavily weighted in this cycle's winners, right? So technology's heavily weighted, energy's 3% of the index or whatever. So coming out of it, they'll all be hit. But coming out of it, you'll still have the heaviest weightings in the sectors that were last cycle's winners, and the lowest weightings in the things you should own. So that means if you're a passive investor, your portfolio's upside down. You're buying the wrong things. By the end of the cycle, it'll be flipped, and energy will be the top of the index. It will be the heaviest weighted, or commodities will be. Industrials will be heavily weighted. Technology will probably be somewhere in between, because we'll still be seeing AI and other technological things winning. But overall, growth stocks will be hurt very badly by rising interest rates. Consumers are not going to be in good shape after getting hit hard in the bust and then facing inflation. Real estate's not going to be doing all that well because mortgage rates are going to go through the roof. So your price of your homes are probably going to be down, et cetera. So utilities probably won't be doing well because they're more tied to their dividends. You'll have some growth in the demand for energy, but and so you go across the board. As basically, as I've known through my 52 years of doing this, every cycle has different leadership, and if you stay with the old leadership, you end up regretting it.
This is a U.S. pivot going, and part of the strategy to counter, if you will, a movement or the global South or the BRICS or the coalition, China, Russia, and so forth, is to dollarize, to have a pro-dollar strategy. I've gone through screening of countries that would be potential, and we've got a list of 50 that would be much better off if they got rid of their current local central banks that do nothing more than just destabilize and replace it with the US dollar, which, by the way, most facto are already done. You go to any place in Latin or virtually any developed world, there are plenty of dollars under the mat. In fact, about 70% of all the US dollar notes, they're not in the United States. Most of the paper money that's circulating, US dollar, is circulating in foreign land.
I like precious metals. I like gold, silver. I like the precious metals space. It kind of is the most exciting space right now. I have a lot of physical metals. So I like that. That's the most exciting thing. We're long equities. We're still trying to ride this trend higher until proven wrong. But other than that, those are the two things. I do like the dollar index as well. I think in the next couple of months, the dollar index could become a very good play. So for international traders, I'm in Canada, to own US dollars, I think is going to be a very good play. I think there's about 10, 15% upside potentially if we do have a global reset for the US dollar index to really rally, and it's a currency just to hold, I think, going forward.
As the discussion makes clear, the real opportunity ahead won't come from clinging to yesterday's market leaders, but from positioning where the next cycle is building strength. Rising rates, strained consumers, and weakening real estate point to a shift away from growth-heavy indexes and towards sectors tied to tangible assets. Precious metals and select miners stand out as the places where capital is quietly preparing for the next significant move. The long-term setup favors gold, silver, and commodity-linked industries, especially as global trust in central banks and fragile currencies continues to erode. Even the dollar, despite its structural risks, may offer tactical upside during moments of international stress. But the lasting leadership belongs to tangible stores of value, assets that benefit from inflation, supply constraints, and monetary disorder. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.